It began like a dream, one so bright, so glittering, so irresistibly intoxicating that an entire nation lost the ability to see the storm gathering on the horizon. The 1920s didn't just roar. They sang a song of effortless wealth, of skyscrapers climbing into the clouds, of jazz spilling out of every club, of new machines, promising a future faster and richer than anything the world had ever imagined. And in the center of that whirlwind stood the stock market, glowing like a golden gateway to a new age of prosperity. But dreams have edges, and this one was sharper than anyone realized. In the early years of the decade, Wall Street felt like a living organism, breathing, pulsing, expanding with every new trade. Stock tickers clattered endlessly, spitting out numbers that seemed to rise with every passing hour. Newspapers printed headlines that made ordinary citizens feel like fortunes were being created on a daily basis. Bankers and brokers walked with a confidence that bordered on divine, and the American public, hungry for a taste of that magic, poured their savings into shares they barely understood. It wasn't just the wealthy buying in, it was the most dangerous part. The stock market became the great equalizer, the place where office clerks, factory workers, school teachers, and farmers could all step into the same arena as the Rockefellers and Morgans. With just a few dollars, anyone could become an investor. Anyone could win. Anyone could grow rich. And when you start believing that wealth is a right rather than a risk, the fall becomes inevitable. The story of 1929 doesn't begin with tragedy, it begins with seduction. America was booming. Factories were producing goods at a pace the world had never seen. Automobiles rolled off assembly lines by the millions. Radio spread through homes like wildfire, reshaping the way people connected and dreamed. For the first time in history, the middle class felt powerful. They weren't just surviving, they were participating in a national wave of abundance. And that energy fed directly into Wall Street. But what most Americans didn't see were the cracks forming beneath the glittering surface. By 1926, the real estate bubble in Florida had already burst, an early warning that speculation had infected the country like a fever. Prices for beachfront land had been inflated by rumors, lies, and dreams, not reality. When the truth emerged, the collapse was brutal, yet the stock market kept rising. Every broken bubble was conveniently forgotten as long as share prices continued their upward climb. The psychology of the era was simple. America could not fail. If the country had survived World War I and produced the greatest economic boom in its history, what could possibly go wrong? That was the dangerous question no one wanted to answer. Economists warned of instability. A few cautious analysts whispered about overvaluation, but their voices were drowned out by the chorus of brokers promising unlimited gains. And then came the match that lit the fire: margin buying. It was the financial equivalent of giving a match to a child in a room full of gasoline. Margin allowed people to buy stocks with borrowed money, often borrowing up to 90% of the stock's price. A $1,000 investment could control $10,000 worth of shares. If the price rose, the gains were enormous. If it fell, even slightly, the losses could wipe someone out instantly. People didn't see the risk, they only saw the results. Families mortgaged homes to buy stock. College students invested their tuition savings. Housewives saved grocery money to play the market. And banks, eager to profit from the excitement, extended loans without caution, fueling a speculative frenzy unlike anything America had ever experienced. By 1928, the illusion had become so powerful that even those who sensed danger felt trapped by the momentum. If you warned your friends to slow down, they laughed at you. If you advised clients to sell, they found a broker who promised higher returns. The market didn't just rise, it hypnotized. Behind the scenes, a quieter but far more sinister force was emerging: market manipulation. Pools of wealthy insiders worked together to pump up stock prices, then dump them at the peak, leaving ordinary investors holding worthless shares. Newspapers, paid by these insiders, ran glowing articles about companies that were essentially shells. The public never stood a chance. But the most chilling truth was this: even the people orchestrating the game didn't fully understand how dangerous it had become. By late 1928 and early 1929, the market had broken from reality entirely. Companies with modest profits traded at astronomical valuations. Stocks soared simply because people expected them to soar. Hope had replaced logic, greed had replaced strategy, and momentum had replaced caution. The illusion was nearly complete. What made it so seductive was that, on the surface, life had never looked better. The cities sparkled. Electricity spread into homes nationwide. Consumer goods became more accessible than ever. Credit was easy. Jobs were abundant, and the American dollar was strong. It felt like a permanent golden age. But beneath that shimmering facade was an economy stretched to its limit. Industrial output was flattening. Wages had stopped rising. Farmers were drowning in debt. Banks were fractured and unregulated. And the gap between the rich and the middle class, though rarely discussed, had widened into a silent canyon. Still, the stock market rose, and the higher it climbed, the more fragile it became. There is a haunting moment in every bubble, an invisible point where the dream becomes too big to sustain. Most people don't feel it, but a few do. Economists like Roger Babson warned repeatedly that the market was built on sand. But when he predicted a crash, the newspapers mocked him. Wall Street dismissed him as a doomsayer. Investors laughed and said the boom would last forever, but every dream eventually meets reality. And the reality of the late 1920s was that America had built a tower of prosperity on unstable foundations. Margin loans, inflated valuations, speculative mania, and blind optimism had created a fragile financial world where even a small spark could ignite a catastrophe. The illusion was beautiful, it was thrilling, it was intoxicating, but it was also dangerous. And soon, the nation would discover just how quickly a dream can turn into a nightmare. If the Roaring Twenties were a dream, then greed was the architect, quiet, invisible, working beneath the surface to shape the energy that electrified Wall Street. Greed didn't just influence the market, it designed it. It rewired how people thought about money, risk, and the future itself. And in that decade, greed wasn't shameful, it was patriotic, it was modern, it was the signature of a new America. But greed has a peculiar way of disguising itself as momentum, ambition, and progress. And by the time you see the truth, it's too late. In the center of this era stood a handful of men who understood something the public didn't. The market was not a smooth river flowing naturally upward, it was a machine. And if you knew where the gears were and how to pull the levers, you could steer its direction. You could turn a whisper into a headline, a rumor into a rally, and a lie into millions. This was the age of stock pools and insider rings, secret alliances of wealthy financiers who worked together to manipulate prices in ways the average investor could never imagine. Here's how it worked. A pool would quietly target a stock, usually a small or mid-sized company that could be easily influenced. They bought shares in silence, slowly, carefully, never pushing the price too quickly. Then, once they had accumulated enough, the real operation began. Friendly newspapers published optimistic stories. Market experts appeared on radio broadcasts hinting at a bright future. Brokers whispered to their clients that the insiders knew something incredible was coming. The public, hungry, hopeful, and convinced Wall Street was the gateway to a better life, took the bait. Money rushed in, prices surged. The chart lines pointed upward, and the pool operators smiled. Some of these men considered themselves artists, painting a picture of prosperity with borrowed confidence and borrowed words. Then came the final stroke. At the very peak, when the public was foaming with excitement, desperate not to miss out, the pool dumped their shares. A tidal wave of selling slammed into the market before anyone realized what had happened. By the time ordinary investors understood the truth, the price had already collapsed. They were left holding shards of a dream that had never been real. This wasn't an occasional trick. It was a system one quietly accepted, often celebrated, and rarely questioned. Manipulation was not a scandal. It was simply how the game was played, and the public, they wanted to believe the illusion. They needed to, because beneath the booming surface of America's economy, something deep and unsettling was happening. Productivity was rising faster than wages. Factories could produce more than people could afford to buy. Corporations were profitable on paper but increasingly dependent on speculation rather than genuine demand. Wall Street became the place where those contradictions hid. As long as stocks kept rising, everything felt stable, everything felt possible. But the truth was much darker. By 1929, the stock market wasn't reflecting the real economy, it was escaping from it. Still, the sparks that fed the bubble didn't come only from manipulation. They came from a culture spiraling into obsession. Everyone wanted in. Everyone believed they deserved to be rich. And the most explosive fuel of all was the growing belief that the stock market wasn't too risky anymore, that it had become a kind of economic escalator where the only direction was up. Everywhere you looked, the message was the same. This time is different. This boom is permanent. The old rules don't apply anymore. It's the most dangerous idea a society can believe. New investors flooded the market at a pace unimaginable just a few years earlier. Brokers couldn't open accounts fast enough. People lined up outside brokerage houses like shoppers on Black Friday. They weren't studying charts. They weren't analyzing companies. They were chasing a feeling, a promise of transformation. Margin buying poured gasoline on the fire. Newspapers published stories of factory workers who turned a few $100s into several thousand. Taxi drivers bragged about their stock picks. College students invested their textbook money. Housewives gathered over tea to discuss share prices. Then came the strangest phenomenon of all. Stocks were rising simply because stocks were rising. Momentum had replaced logic. The bubble was no longer just a financial creation. It had become cultural. And culture is much harder to stop. But behind the glamorous facade, behind the champagne parties, the skyscraper construction, the booming car industry, and the flood of new radios, the gears of Wall Street were grinding faster than ever. Brokers extended margin loans without restraint. Banks tied their survival to the market's upward march. Corporations diverted profits into speculation instead of production. Everyone was borrowing from the future to enjoy the present. The machine was overheating. Inside the offices of major investment houses, the mood was shifting. A few senior bankers felt a quiet dread building. They knew the fundamentals didn't justify the soaring prices. They knew the debt levels were unsustainable. They knew the market was living on borrowed time. But what could they do? Try to warn the public? Nobody wanted warnings. In a bull market, caution sounds like madness. Even the Federal Reserve sensed the growing danger. In early 1929, they tried to curb speculation by raising interest rates and urging banks to restrict loans. But Wall Street found ways around every barrier. Where traditional credit tightened, new lending channels opened. When the government spoke softly, the market roared louder. Confidence smothered caution, momentum smothered logic, and greed, quiet, relentless greed, kept pulling the world closer to the edge. The spark behind the euphoria wasn't just money, it was belief. It was the intoxicating notion that America had unlocked the formula for endless prosperity, that the lessons of past crashes no longer applied. That risk was an outdated idea. This belief didn't merely inflate a bubble, it blinded a generation. And while the machine was humming louder and faster, while the country danced on the edge of a cliff, a few people sensed a chill in the air, a strange tension, a feeling that something was off. They couldn't see the entire picture yet, but soon, the illusion would shatter, and the spark that had powered a decade of dreams would ignite the most devastating crash in American history. It began with a whisper, small, quiet, almost dismissible, a few uneasy glances inside brokerage houses, a handful of nervous conversations on street corners, a tension in the air that ordinary citizens couldn't quite interpret but instinctively felt. Something was wrong. On the morning of Thursday, October 24, 1929, Wall Street did not roar with its usual confidence. The sky over New York hung low and gray, as if the weather itself sensed the shift. Normally, the bustling crowd around the exchange crackled with optimism. But on that day, the excitement had curdled into a strange, electric dread. By 9:30 a.m., before the opening bell even rang, a storm was already gathering inside the exchange. Phones were ringing violently. Messengers were sprinting between offices. Brokers wore expressions that mirrored a battlefield metacomposed on the outside, shaken on the inside. And then it happened. When the bell rang, the market didn't open, it collapsed. Within minutes, a tidal wave of sell orders slammed into the ticker. Prices didn't fall gently. They plunged, dropping point after point before the public even knew what was happening. The ticker tapes, the lifelines of the market, fell hopelessly behind, printing prices that were already outdated by the time traders read them. Panic spread faster than ink on paper. Crowds outside the stock exchange grew to thousands, pressing against police barricades. People shouted for news, desperate for any scrap of information. Inside, the trading floor turned into a scene the world had never witnessed before. Men who had strutted through life with the confidence of kings were suddenly pale, sweating, shouting until their voices broke. Some tried to sell everything they owned. Others tried to save the stocks they believed were still worth something. But none of it mattered. The market had slipped into freefall, silent at first, then screaming. The crash wasn't a single moment, it was a chain reaction. As prices dropped, margin calls exploded. Investors who had bought stock with borrowed money suddenly owed far more than they could pay. Brokers who had extended those loans recklessly began to panic as well. They needed cash to cover those collapsing positions, and the only way to get it was to sell even more shares. Every sale triggered another fall. Every fall triggered another margin call. The cycle fed itself, each turn tightening like a noose. By mid-morning, the market resembled a living thing fighting for air. The noise inside the exchange was deafening: shouts, slamming phones, the frantic scratching of pencils on order slips. Clerks pushed through crowds with stacks of paper that trembled in their hands. The most seasoned traders, men who had weathered panics before, looked shaken to their cores. But the most terrifying part, nobody could explain why it was happening. Rumors spread like wildfire. A major bank was failing. A powerful industrialist had gone bankrupt. Foreign investors were pulling out. The president had died. None of it was true. But in a panic, the truth doesn't matter. By noon, the fear had become uncontrollable. The pressure inside brokerage houses overflowed into the streets as runners delivered devastating messages. Portfolios wiped out, fortunes erased, life savings reduced to dust. At one branch office downtown, witnesses later recalled seeing grown men weep openly. Across the country, telegraph lines glowed with frantic messages. Small-town brokers in Kansas, Ohio, Texas, and beyond watched helplessly as their customers' investments evaporated in real time. The American dream wasn't merely cracking, it was crumbling into sand. Back in New York, something extraordinary unfolded. At 1 p.m., a convoy of limousines pulled up in front of the exchange. The doors opened, and several of the most powerful bankers in the world stepped out. These were the titans of American finance, the men believed to be capable of stopping anything. They marched into the building and disappeared into a private room. What happened next would become legend. J.P. Morgan & Co., Chase National, National City Bank, and other giants formed an emergency alliance. They pooled millions in an attempt to create a financial bulwark against the tsunami of panic. Leading the charge was Richard Whitney, the acting head of the exchange. He walked onto the trading floor like a general entering a collapsing battlefield. Whitney strode to the post where U.S. Steel, the strongest, most respected industrial company in America, was traded. Its shares were in freefall. Without hesitation, Whitney shouted $205 for steel. He wasn't asking, he was declaring. The price he called out was far above the collapsing market. He wrote a massive order backed by the banking syndicate, an attempt to send a signal that everything was still under control. For a moment, the crowd froze. If Whitney was buying at that price, if the banks were stepping in, maybe the panic was over. Maybe the market could be saved. Hope flickered like a candle in a storm, and for a brief time, the tactic worked. Prices steadied, some stocks rose. The screaming softened into tense murmurs. Reporters rushed into the streets with the news. The bankers have saved the market. The crowd outside cheered. Investors sighed in relief. Phones began ringing again with cautious optimism, but the celebration was premature. Whitney's dramatic gesture stopped the bleeding, but it didn't heal the wound. Because beneath the surface, something had shifted forever. Confidence, fragile and visible, essential, had cracked, and once confidence breaks, there is no easy way to piece it back together. As the afternoon wore on, fear still lingered. People understood that what happened that morning wasn't just volatility. It was a warning. Nobody could admit it yet, but the truth was undeniable. The market was wounded. The illusion of invincibility had shattered, and the world was quietly sliding toward an abyss. Black Thursday didn't end the prosperity of the 1920s. It exposed the lies that prosperity was built on. And though bankers had halted the collapse for a moment, the forces that had been unleashed were far too powerful to contain. The worst was yet to come. In the days following Black Thursday, New York City woke each morning hoping the nightmare had ended. But the truth is, once fear infects a financial system, it behaves like a virus, mutating, spreading, tightening its grip on every institution that depends on confidence to survive. And Wall Street, for all its marble and steel, for all its millionaires and titans, was far more fragile than anyone had dared to admit. The bankers' intervention on October 24th had stopped the freefall, yes, but it hadn't killed the panic. It had merely paused it, like a temporary bandage over a wound that was still bleeding beneath the surface. Over that tense weekend, newspapers printed soothing headlines, editorials urged calm, radio hosts reassured listeners that the crisis was nothing more than a momentary disturbance. Even President Hoover stepped forward with a confident proclamation, insisting the nation's economy was sound and prosperous. But the public wasn't convinced. Deep down, something felt broken. And in the dark corners of Wall Street's tallest buildings, the people who truly understood the system, the bankers, the brokers, the executives, felt a growing dread. They could see the numbers. They could watch credit tightening. They could sense money evaporating from the system like steam from a boiling pot. The crash was no longer just a market event. It was becoming a structural failure. On Monday, October 28th, the anxiety finally snapped. When the market opened, a fresh wave of selling roared onto the floor with a force even greater than the chaos of Black Thursday. Nothing could stop it. Prices fell so quickly that the ticker, already overwhelmed the previous week, couldn't keep up at all. It lagged nearly 2 hours behind, feeding investors information that was dangerously outdated. Panic doesn't need truth to grow. It feeds on uncertainty, and uncertainty was everywhere. Industrial giants that had symbolized American strength for a decade were now hemorrhaging value. General Electric, U.S. Steel, Montgomery Ward, even the mighty AT&T companies that had weathered wars, recessions, and fierce competition were suddenly being sold off like failing businesses. But the most terrifying insight came from the banks. As stock prices plunged, the collateral behind millions of loans also plunged. Margin accounts that had looked safe a week earlier were now radioactive, and the banks that had extended those loans trusting the market to remain stable were suddenly staring at the same abyss as their customers. The first institutions to wobble were the small regional banks. Their customers weren't wealthy financiers, they were farmers, bakers, factory workers, but these were the banks that had lent their depositors money into the stock market through indirect channels, believing it was a guaranteed path to easy returns. Now, those investments were turning to dust. Bank presidents tried to reassure the public. They issued statements, smiled for newspaper photographs, stood behind polished wooden counters and swore that deposits were safe. But people weren't listening anymore. They were watching the market bleed. They were watching fortunes vanish. They were watching the powerful look suddenly powerless. And when trust dies, the run begins. Across America, depositors stormed their local banks, demanding their money back in cash. Not tomorrow, not next week. Now, but cash reserves weren't built for panic. A bank could survive almost anything except fear. As those smaller institutions teetered, the real danger loomed over the financial skyscrapers in Manhattan. These were the giants, the too big to fail institutions of their era. They had the deepest pockets, the most influence, and the most to lose, yet even they were buckling. National City Bank, Chase National, and others had poured massive sums into margin loans and speculative investments. Their balance sheets looked strong only as long as stock prices remained high. But now, for every point the market fell, the pressure on these banks intensified. And then came Tuesday, October 29th, Black Tuesday, the single most destructive day in Wall Street history. From the opening bell, the market went into free fall so violent that even seasoned traders would later struggle to describe the horror. 33 million shares traded hands, an unimaginable volume for the time. Phones rang without pause. Clerks collapsed from exhaustion. Some brokers simply froze, paralyzed by the sheer scale of the collapse. Even the titans, the men who never bowed, never flinched, felt terror gripping their chests. Inside the offices of major investment banks, executives watched their empires crumble. Their personal fortunes, once so vast they seemed untouchable, were evaporating minute by minute. Some tried to rally their teams. Others stared silently at the numbers rolling across their tickers. Knowing the truth was unavoidable, their world was collapsing. One of the most devastating impacts was the destruction of investment trust entities that had risen to immense power during the late 1920s. They were marketed as sophisticated, expertly managed financial vehicles. In reality, many were over-leveraged houses of cards built on inflated stock prices. As trust values collapsed, they dragged everything they touched down with them. Corporations that relied on these trusts for capital suddenly found themselves cut off. Loan renewals vanished. Expansion plans were scrapped. Factories preparing for growth now faced layoffs. The wreckage spread outward like ripples from a stone thrown into still water. But the human cost cut deeper than any number printed in a financial report. On Wall Street, some brokers broke down publicly. Others lashed out in panic, shouting orders that no one could fill fast enough. Dark, ominous rumors circulated of investors unable to bear the loss. Newspapers later exaggerated these tragedies, but the emotional truth remained. Despair hung over the city like a thick fog. For the first time, the American public finally understood that the crash wasn't a market correction. It was a collapse of trust, a collapse of credit, a collapse of the entire illusion the 1920s had built. Even J.P. Morgan circled the men once considered financial gods could no longer stop the bleeding. They threw money at the problem, coordinated emergency meetings, issued statements of confidence, and still the market fell. Because the truth was simple, the bubble wasn't bursting. The bubble had already burst. The only thing left was the wreckage. By the end of Black Tuesday, billions of dollars in paper wealth had vanished. Blue-chip stocks had lost half their value. Entire fortunes had been erased in hours. The titans who once shaped the economy with a signature or a phone call were now watching their power evaporate in real time. The dominoes had fallen, and the collapse of the titans would soon unleash a far greater tragedy on the rest of the nation.